Welcome back to Learn SKN, and today we are looking at question number 2 from the 2022 January POB paper 2. So that's the January 2022 past paper 2, and we're looking at question number 2. And we looked at question number 1 last time, so you can check that video to see what we did for question number 1. And so before we jump into it, you know what to do. Like the video, subscribe to the channel, hit the bell so you know when Learn SKN drops another video, and try and share it with your buddies, your friends, your relatives, whomever you want to help to pass the subject. To try and share the content with your peeps. All right, let's get the community growing. And again, let me just thank some members of the community for emailing me this paper in particular. So number 2, state 3 reasons why it is important for a firm to have proper documentation in all of its business transactions. And so right here, what we're looking at is the importance of record keeping, right, in business transaction. And that's on page 138, unit 4 in your textbook, part of the legal aspects of business. So if you have a textbook, you look at that and you'll see what they are talking about, record keeping. So record keeping is therefore defined as the process of creating, collecting, and maintaining records or documents which act as evidence of business transaction. And so the question asks us to just simply state, right? Just state. They don't want us to go too far, go too deep, right? Just state the reasons why it is important. And so if you look at this nice table right here in our book, reasons why record keeping is important, right here to the left, you have a whole lot of reasons here. You choose 3, and that should give us the answer. And remember, we said state. So state is normally, you know, a sentence or so. Remember, state is not like listing. Listing, maybe some words also, 1, 2, 3, 4, 5, whatever. But state, we're talking about a nice sentence. So for example, one reason: to safeguard and retrieve information about sales, customers, and suppliers. That's one reason. And next one, to monitor business performance. And next one, to inform business decision making. So you can use records to, you know, make proper decisions. And next one, to meet legal requirements. You know, by law you have to keep certain records. You can't dispose of them after only after a certain time, because you need to have to do your auditing and your checks and stuff like that. So legally you have to keep certain documents. And we have on here, reduce the risk of theft and fraud. So those are reasons why you might want to keep records, proper documentation of all your business transactions. So any of those, 3 marks. B, outline the purpose of each of the following types of business documents. And so again, same chapter, we're looking at the types of business documents now from the same chapter. And so we are going to now look and see where we can find those. So, you know, we have a whole bunch of business documents out there. Look at that, the whole list right here. But they're asking us for pro forma invoice and purchase requisition. So the pro forma invoice in our textbook, we have how it looks. So we're going to come back to that later on. We're looking at pro forma invoice right here. So, you know, when you want to order something online also, they would send a pro forma invoice to you. It's not the real invoice, but it's just an example to show all this stuff that you're getting, the content, the address, all that kind of thing. So the purchase department will request information from the potential supplier about products, quantities, and prices. The supplier will send back a pro forma invoice. What is that? A pro forma invoice is an estimate or quotation, also known as a preliminary bill of sale. So that's the thing right there. It's a preliminary bill of sale. And so the purpose here is to, before you buy anything, before you spend your money, you want some ideas about the product, the quantity, and the prices. And so you send for that information, and it comes in the form of the pro forma invoice. It itemizes the product or services a supplier is willing to deliver to a customer at a specific price. And so that's what we need to know. How much you getting, what price. So looking at the product itself, the quantity, and the price, all that is in the pro forma invoice. And that's the purpose of it, to give an idea as to what you're buying, how much you're buying, and the price at which you're buying it. And you have the example right there. That's a pro forma invoice, not a real invoice. right? So they said performance invoice will also often include details regarding shipping process. So that could be a reason for it too. Shipping process such as packaging, weight, and delivery charges, right? So you need that for when you're clearing your items at customs. So all these are reasons why you would want to, that the purpose of the performer invoice. Alright, and next one, in situations where the buyer is new or the seller does not trust that the buyer will pay for the goods after they have been delivered, the performer invoice seeks to request payment before goods are delivered. So you can use performer invoice to get payment before the goods are delivered, and a lot of times it is used in online shopping, online buying. When you're buying a car from Japan or stuff like that, they send the performer invoice, you get your funds in order, and then you can use the performer invoice to pay for what you owe the people, right? So all those are purposes that the performer invoice can be used. Then they said the purchase requisition, right? Purchase requisition. That's normally something that is used within the company. It's normally somewhat of an internal document. It is an internal document used to inform the relevant persons, whether it is purchasing staff, manager, finance personnel, in a business that a purchase is being requested. That's the purpose right there. So let's say that you have a business and you have multiple departments. If one department wants to purchase something, they can use that form to inform, let's say, finance or the boss exactly what you're about to purchase. So they say it is an internal document used to inform the relevant persons in a business that a purchase is being requested, and that is the purpose of it. These relevant persons have the purchasing authority or responsibility for how money is allocated or used, so the approval is necessary before the purchase can be made. Purchase requisitions should state the item and quantities being requested, the expected price and suppliers of the item, the department requesting the purchase, and the objectives hoped to be achieved by the purchase. So we're saying that within a business, you use the purchase requisition form internally to let different departments know you're purchasing certain things, because sometimes you can't sign a check, right? You have to go get somebody else to sign a check. So they need to know, why are we signing a check? What are we buying? And so that's what the form would let them know. And you have an example right here. Alright, don't forget you can use the textbook to study. If you do not have access to the textbook, you can look at one of the links in the videos to try to get your hand on it. Alright, good. So that's B for number 2. 2 easy marks for each. C. List 3 types of non-life insurance policies. 3 types of non-life insurance policies. And again, we're looking at the legal aspects. And so if you go down to look at the insurance section, we have a whole lot of insurance out there, types of insurance out there, right? And so we have, let's see, of course we have auto insurance, right? We have some types here. They say non-life. So let's look at what we have here. Non-life. So of course we have life assurance. We also have, of course, auto insurance. We have general liability insurance, public liability insurance, property insurance, auto insurance, workers' compensation insurance, professional liability insurance, product liability insurance, health insurance. I mean, it goes on. Event insurance, good in transit insurance, marine insurance. So you have a whole list you can choose from right here from your textbook. And they just say list 3 types of non-life. And so list any 3 and you're good to go. You have a lot to choose from. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. You have a whole lot to choose from. Choose any 3. Simple ones, marine insurance. You have fire insurance or property insurance. You have accident insurance, health insurance, general liability insurance. So you have a lot to choose from, right? So any 3, you get your 3 marks. Easy, just like that. Now, they say, describe 2 principles upon which insurance is based. So ain't no listing, ain't no state, you have to describe, right? So the principles of insurance, there are quite a few principles of insurance out there, and so we're going to look at some of them right here, right? So here we go. let's see where we're going to start from. So, principles of insurance. So the first one here we can look at is utmost good faith, right? Utmost good faith. A very easy one to remember, right? A very easy one to remember. What it's talking about? You have to be honest, right? You have to be honest when you come into the insurer. So you have to give them, you cannot lie. Both of you, right? The insurer and the insured, they have to be honest about what exactly is being insured and what you get for insurance. That's why we're talking about utmost good faith. It means that both parties, insurer and insured, must enter into the insurance contract with utmost good faith, or in other words, trust and honesty. Right? You have to come to with trust and honesty. You have to have good faith when entering into this insurance policy. Both parties must disclose all relevant facts and issues related to the insurance contract. So, no lying. Be honest. Say what is what. You know, some insurance companies love to fool with their fine print. None of that. Be straight up. You know, some people, when they're being insured, they hide certain sickness. They hide certain things they do. None of that. Be honest. Be straight up. Utmost good faith. That's one principle. Then we have insurable interest. What this means is that when you're going for insurance, right? Yeah, you have to be the one who is stand to lose something. You cannot go and insure something that belongs to someone else. It has to be yours. So you have to. So whatever you're insuring must belong to you. The car must be yours. The house must be yours. The building must be yours, right? You cannot insure your neighbor's building. You cannot insure your neighbor's car. So what is being insured must belong to you. So insurable interest is the monetary interest in what is being insured. So they're saying this means that an insured person will lose money if the event they have insured against occur. So if you insure a house against fire, it has to be your house. So that if the fire occurs, you are going to be compensated. Not that you insure somebody else's property and then fire burn it down and you get their money. And so you go. You insure what belongs to you, insurable interest. Then you have indemnity. The principle of indemnity means that in the event of a loss, the insured person should not be better off or worse off than before the loss. Indemnity restores you to the same financial position before the loss occurred. So they're saying is that you should not profit from insurance, right? You should not profit from insurance. You should be placed in the position you were prior to the loss. So if you had a car that cost $5,000, I mean, let's be realistic, right? Okay, $20,000, and the car got in an accident, then we'll compensate you for the value of the car, $20,000. They're not gonna give you 30 or 15, right? Because they're gonna put you back where you were before the accident, and that's what indemnity is all about. You must be in the position you were before the incident occurred. You shouldn't be better off, or you shouldn't be worse off. And that is why people go to jail for insurance fraud, right? People try to hustle the insurance company and they end up in jail for that. So that's another one. That's a third one. How much they asked us for here now? They said 2. Fourth one, contribution. What this speaks to is that you cannot have multiple claims on the same thing with different insurance companies. So let's say you have a car. You cannot insure your car against accident with 10 different companies and expect to get the same amount of money from all of them. No. If the car has a value of $20,000 and you insure one for whatever, if you insure with 2 companies, they're going to split it down the middle. So I'm going to give you 10, they give you 10, half, we're good to go. Don't expect to get 20 from one and 20 from the other one. And so you go. You're going to get piece from one, piece from the other one, right? Proportion. So they contribute towards the value of the item. They are not going to give you the same, all of them are not going to give you the same amount that you insured for, that the value of the product is for. So again, if the car is 20,000, you're not going to get 40,000, 20 from each. No. You're going to get 10 from one, 10 from another one. Or whatever the arrangement is between the 2 insurance companies, you are going to get the 20,000, but each going to contribute whatever the amount is. And so that's the next principle right there of insurance. Then we have subrogation, which means that the principle of subrogation means that the insurance party will be able to sell the damaged asset for their scrap value or it can be proved that the damage was caused by another party, it can recover its cost from them. So here what we're talking about here, subrogation. Let's say your car get in an accident, right? The car costs $20,000 or whatever. The insurance is gonna pay you for that. But the wreckage now belongs to the insurance company. So you can't claim the $20,000 and steal the wreckage and then sell it and get some extra. No, remember, you cannot be better off. So you can't get back the money for the car and steal the wreckage. No, you pay off for that. The wreckage belongs to the insurance company. Right? The wreckage belongs to the insurance company once you pay for that. And so that's subrogation as a principle. Whatever the asset that was damaged, that now belongs to the insurance company, and you now just get compensated for that. Right? So you can't go and say you're claiming the remnants and sell it, sell it for spare parts or something. Instead of go. Right? So that's subrogation. Then we have what we call, so that's subrogation. Next one we have is loss minimization. So what this principle speaks to is that, let's say for example, your house got caught on fire, right? You should try your best to get the fire out, whether you have to call the fire department or whatever. You can't just see the house on fire, stop there and say, well, insurance will cover me, and try to do nothing. You have to try to minimize your loss, right? Or else the insurance company, if they can prove you did not minimize your loss, they're not going to compensate you fully, right? They're not going to compensate you fully. You have to try your best to prevent the accident, or try your best, don't be negligent, or try your best to get the fire department here on time to out the fire. You can't drive without a license or things like that, or else you're going to be at fault. So you have to try and minimize your loss in terms of whatever is insured, right? So you can't just stand back and say, okay, well, insurance don't cover me, so I ain't going to try to do nothing. No. So the best example is the house on fire. You have poor regulations, you see the house on fire, you ain't calling the fire truck, nothing. Then if they can prove that you're being a little negligent, then they might not pay you what the full value is. And so all those are principles of insurance. A very easy one, next easy one here is proximate cause. Proximate cause is they're saying that you have to insure, or you'll only be compensated for what exactly you're insured for. For example, if you insure for fire damage and your house gets flood damage, you cannot get any insurance for that because it was a flood, but you insure for house, for fire. So that's what you call proximate cause. You're only going to be compensated if whatever you insured for is the exact cause for your loss. If it is not, you're not going to get covered. So proximate cause. Whatever, so if you insure for fire from, let's say, an accident, and then you happen to have lightning struck your house on fire, act of nature, they might say, well, the fire was caused by act of nature, so you can't get compensated. This is kind of trickery to use, right? So you're only going to get compensated if your loss is from the approximate thing that you're insured for. If you say you're going to insure against hurricane, flooding, and you pipe bust in your house and flood your house, that ain't covered, man. And the last question here on number 2 from the January paper, explain 2 ways in which insurance could be used to lower the risk associated with business, right? So kind of an application-ish question. Again, trust the textbook, answers right there. How insurance promotes business activity and trade. Very simple, very straightforward. Insurance reduces the risk of operating business because it protects business owners from financial losses that will reduce profits. Right there, we have an example right there. For example, catastrophic fires or major personal injury claims could halt production and result in bankruptcy. Insurance is crucial to financial and organizational stability. This is because liability can quickly lead to a business and its owners into bankruptcy. Without insurance, business would have to draw down their financial reserves or sell off assets. Insurance may be needed to repair or replace damaged property or pay compensation to settle lawsuits, such as for injuries suffered on the business premises or due to faulty equipment or products. Sole traders and partners with unlimited liability may have to draw on their personal savings or sell their positions. Business can offer to provide private medical and car insurance cover for employees. This can be in order to attract, retain, or motivate skilled employees to achieve business goal. So you see two examples right here, right? Insurance can be used. What the question asks us here: explain to business insurance can be used to lower the risk associated with business. So one way, easy way, right? They say it can be used to protect owners from financial losses that will reduce profit, such as being sued, such as production being halted, such as fraud, thievery, all those kind of things. So it can protect business owners from financial losses from a variety of different things, right? So that's one way in which it can help reduce the risk associated with all of those things: fraud, theft, injury, those kind of things. Also, it can be used to reduce the risk of employees leaving, right? Because I say here, look at what they say here. Look at what they say here. Insurance can offer to provide private medical and car insurance covered for employees. This can be in order to attract, retain, and motivate skilled employees to achieve business goals. So you can use insurance to reduce the risk of persons leaving your company. Some people stay with a company simply because the insurance is there for their family and whoever else they're looking after, their beneficiaries. So they stay there. So that's two you have right there. Now you can break down the one about financial losses into so many things, right? Such as if production halts, if there's fraud, there's a lawsuit, if there are injuries, all those things can add up to a lot of money. And so to prevent bankruptcy, insurance is there. Also, it can help to retain workers. Another way in which it reduces the risk of doing business is that when you have insurance, it can help to, it can be a form way of financing your company or your business. Instead of using your savings or whatever, you can use insurance policies and things like that as a way to finance some of your ventures, right? I've seen some insurance have savings built in, and so you can use that to help to, especially sole traders, you can use that to help to finance various ventures, right? So those are some simple ways in which insurance, it's two, so it's 3 marks each, so you can really break down things like the financial aspect of it, give examples. You can break down the talent retention aspect of it, giving examples. You can break down the source of financial aspect of it, giving examples. And so that would give you your nice 3 marks for that. Again, textbook has all the answers. I'm not advocating that you go and learn these things verbatim and when try to remember. No, put them in your own words so that you can remember. But the book is there, so you don't have to just pull them out to the ear just like that, right? So those are ways in which you can you can help to get this exam done a little better, right? So those are some examples. So you know what to do now. We that's it for this question. So you know what to do now. Stay tuned for when you handle question 3415, right? But the only way you know when learn SKN jobs question 3415 is by subscribing to the channel, hitting the bell, and maybe sharing. If you share, somebody might say, okay, I subscribe, maybe you in, but